Hi everyone. Welcome back to the podcast. Today we have a very amazing guest. This guy is Jon Chu. He's a legend in the VC space, I guess you could say, because of his background coming from Palantir, and he's had an amazing career stint. So, in my opinion, he's a legend. Uh, could you just talk us through what was your journey to Khosla Ventures like, and yeah, just could you share a bit on that front?
Yeah. So I kind of fell into venture in some regards. I'd it was right past 2021. I'd been through a couple IPOs and I was basically retired at Facebook doing machine learning. And I'd known one of the partners at KV for a long time, so that's how I got introduced to Vinode. And Vinode was actually trying to get me to start another company. And I was kind of like, I have a 1 year old. This is like the worst time in the world to start another company. And he was kind of like, okay, well, then you should join me and invest, and you can live vicariously through founders. Um, and I didn't really think venture was for me. So it took about a year of him prodding, but eventually um, succeeded in convincing me to hop over to KV. And that's how I ended up here.
Yeah, that's an amazing experience that you talked about, like how Vinod Khosla actually convinced you to come and work for him at Khosla Ventures. So, my next question is: so, what is exactly the investment thesis of Khosla Ventures, and like what kinds of founders do you look for, and what kinds of founders do you back eventually?
Yeah. So I wouldn't say KV is a particularly thesis driven fund. So, as most venture firms actually are, they're a collection of partners, and each partner actually can have different opinions. So, some of us have theses on certain areas. Some of us are completely non-thesis driven and just let the founder tell you about the market itself. I would say, like, one of the overarching things that we've been heavy on since basically like 2013 has been that AI is transformational technology, or like realistically, it's machine learning is transformational technology, and it's going to automate a lot of what you see in the world. And if I were to break it down, I actually see a few different levels. So like there's um there's kind of like AI infrastructure companies or foundation model companies. And for those ones, I actually don't think many of them will be valuable that are started today because you already have incumbents like OpenAI, or Google has a lab, Facebook has a lab, right? So the things that are really nichey, or the things that are tackling captive markets that other people wouldn't touch, or things that have really, really out of left field research that creates breakthroughs, are the interesting ones with opportunities. One example there that we've invested in would be like Sakana, for example. So I did Sakana foundation model for Japan, but like realistically, Japan's government defense tech won't use OpenAI because it's like not great for your government if the US can just shut it off in an instance. Um, and then, like further up the stack, we think humans will be more efficient with co-pilots and other types of automation. And then some jobs will just be completely automated away by different breakthroughs in AI. So that's like one area. And in terms of founders, we what we really like in founding teams are people that really understand and know their market domain and are highly technical. So as a whole, I think the partnership tends to lean more technical than most VC firms that you see. And a lot of us, the vast majority of us, are actually ex founders. So we tend to really gravitate towards that type of persona.
Yeah, I think that's a really interesting take, like how you mentioned about like Khosla Ventures being a very technical kind of background VC fund, which is quite different than the majority of the VC funds. And my next question is: so, what do you think apart from AI is like the next hot industry for startups? Like, what in your opinion is like this next hot industry? And yeah, could you just share something on that front?
Yeah, I actually wouldn't really categorize it that way. I would probably say that every industry right now is probably a hot industry. And it's not so much like I don't really categorize AI as like an industry per se. It's a piece of technology. So like machine learning, foundation models, LLMs, they're just breakthroughs in technology that can be applied to different industries. So you'll see biology being and chemistry being transformed by foundation models and breakthroughs in machine learning, right? And like that's an industry that's interesting to look at because machine learning can automate things there. Consumer is a world where like different types of consumer experiences can actually be created because you have new technology that actually enables it, right? Or enterprise, like different types of the enterprise stack will have different forms of user engagements and different capabilities that can actually be unlocked. So you'll see transformation in enterprise companies. So I'd say like there's opportunity in basically every industry right now for transformation. The question is, and the thing that I think makes one company interesting versus another is what gives your product and your company staying power to not get run over by someone else that is trying to also tackle that market or an incumbent that's also moving in. Because I think like a lot of startup founders actually go by the colloquial like YC wisdom of like ignore Google or ignore Facebook, and like FANG will never kill you, so just focus on other startups. And right now that's true for some markets and not true for many, because these are foundational technologies inside of the domains that these companies actually care about and are actively working on. One great example of that would be Adobe. Adobe has basically wiped out multiple markets by adding AI to their product suite over and over again. So they're fairly good at this. So just ignoring the incumbents is not a great strategy at this point.
Yeah, let's riff on that a bit. So I read somewhere on your X, I think, on your timeline, you had made a post about YC being a YC admit. So could you just talk us through some short advice that you have, like maybe a few pieces of advice you have for people that are trying to apply to YC, and like what could you just share with them today?
Yeah. So I, for context, I actually got into YC back in like I think it was 2012-ish or 2013-ish, somewhere around there. But we actually didn't end up doing it. So I can't say much about the program specifically, but I think for YC has not changed that much in that they still focus on um, really great people that are in potential markets that may go somewhere. And they invest in those founders and they basically tell them like there's two things that you really need to do. And this is all correct. One is you need to build a product that is really good and make something that people actually want. And the second thing is that you need to be able to sell it, right? And get some distribution. And in the early stage, those are the only two things you should really focus on. Um, so I think like being able to convey that story pretty clearly to the YC partners on why is this something people actually want and how you're the right team to both build it and distribute it will do wonders. And it's actually not that different than pitching to a venture firm. It's just like at different stages, there's different bars of expectation on how far you are on the build and how far you are on the distribution side of things. I will say the one thing YC focuses less on, I think, by nature of being an accelerator with high volume, is they're a little more flexible on the ultimate market size of the thing itself. Versus a lot of venture firms do need to be fairly confident there's some kind of potential unicorn or decacorn like outcome for each individual company.
That's a pretty insightful take that you've given on like some advice for YC. And just to recap, like I guess distribution and selling is like some of the key takeaways that I got out of that. So, given that you're a former founder yourself and you've kind of seen the growth of companies like Open Door and like Palantir and stuff like that, and you even had a short stint at Facebook as well. I don't know if it was a short stint or not. You had some kind of a stint at Facebook. So talk us through like what does it take to distribute a product in this day and age, and like what are some strategies you could share for founders like today? Like what could they implement and what could they do to distribute their product?
Yeah, I think there's not really an answer here because it's different for every single product. Like the Facebook one is probably the easiest, right? Like you see this problem all the time where founders come out of something like Facebook or Google and they've like shipped a really successful product there in the past and they flounder when they do a startup because like the answer to Facebook distribution is Facebook has 1 billion users. Let's just put it in front of them and see what happens, right? So like that problem is kind of solved for you at a big company. Um, at a Palantir, it very much is just enterprise sales. Now, like they didn't have actual enterprise salespeople, so it very much is engineers doing enterprise sales. But it's the same thing where like you go to the customer, you find out what their need is, you talk to them, you tell them like I can solve your problem by doing X, And Palantir like hacked that a little bit by being a bit of a services company in the beginning, with like a product backing, but a lot of the forward part was services, and then eventually coagulating the whole thing into a product at the end of the day. But that's fairly risky, right? It makes the sales easier, but also if the product doesn't show up, then like your future prospects don't look great. Um, the thing about Open Door was like you just go up to people in the beginning and be like, okay, I can spot price your house. Do you want to sell it? And if you make the price high enough, eventually someone is going to buy it. Or sorry, someone's going to sell it because the product to a seller is just pure dollars. So you give them more dollars, they will sell their house. The downside of that is you might not be able to resell it for anything more than what you bought it for, or maybe even less. So for Open Door, distribution really was about like, how do I find people that are selling their houses? And how do I find them before a real estate agent is about to take their 6% cut? Um, and like you try multiple things. They've tried ads. And one of the things that worked really well for Open Door, which is kind of surprising, but like when you think about it, it makes sense, is actually in every Open Door house that actually gets sold, you just put a little sign with like a baby blue Open Door logo on it that says like Open Door selling this house. And it's the same way realtors actually sell and distribute themselves. But like because the blue is eye catching, people are like, oh, what's that Open Door thing? And then you get distribution just from eyeballs, right? Um, so each company needs to figure out the right way to do distribution and one that's unique for the company. There's ways to hack it, but I think like people need to think about it from the beginning. So, for example, if you're an infrastructure company, maybe open source is the right way to get distribution. Like it's a double-edged sword, right? But if you build an open source community, that's highly defensible and a way to actually get attention and get your product into people's hands. So each of these companies and each of these markets has a different angle that's correct for distribution.
I think that was some really good insight that you shared about distribution and especially about your various experiences at these phenomenal companies and kind of how you saw distribution play out. And so, my next question is more like, can we discuss a bit about your thoughts on Mark Zuckerberg and what it takes to be exceptional at what you do? Like, you had a stint at Facebook, and I think I saw somewhere that you even like had some in interactions with Zuckerberg himself. So could you just share a bit about like, but correct me if I'm wrong, but like, yeah, could you just share a bit about that as well?
I don't um I mean like he's an exceptional individual. Like it's just based on what he's accomplished, it's really hard to get there. I'll say like Zuck is someone who there's two things that's interesting about Zuck. Zuck will is still like a product person at heart and still a founder and will go deep on things and will like noodle in exactly into the thing that he cares about your product and the thing that he thinks is what's broken. And I think like most really good executives that you'll meet actually end up doing that. They care about the product, they care about the systems, and they can go deep. And no matter what level they're at, they can go deep and figure out what the key questions are that make or break a particular product or a particular system. So Zuck definitely has that. Uh, the other thing I think I'll say about Zuck that's quite unique from executives I've seen is he's not afraid to take risks with Facebook, even at its size, and or I should say Meta at this point, even at its size. And he's willing to basically lay down his influence and say like, this is the direction I think the company needs to go in. This is like the key strategic question that we actually have to do, and we're going in this direction. And it's part of the reason why you see Facebook in the current mode of success that it's in today. He's very good at moving very quickly and chasing down opportunity. And I think if you had somebody else at the helm that wasn't a founder, that didn't have the trust with the company that Zuck has, you wouldn't be able to do it. Like there's other companies right now, other FANG companies that are arguably struggling to adapt to AI. Facebook has done it very quickly and is a leading player in foundation models. Some of the other companies here should be leading players and have been able to, and part of it is because they don't have the speed and the push that a founder actually can do.
Yeah, that's a super interesting take and a super interesting insight into like Mark Zuckerberg and like how he operates and how he thinks and how he's created Facebook into such a dominating player in the space. And so
I'll say
my
like enough credit. He is probably one of the top 5 CEOs on the planet right now. And like he doesn't get enough credit for that because I don't know, Facebook had some bad press in the last 10 years. It's really weird. Like when I started in the industry, Facebook was the darling. They could do no wrong and they were a fantastic company. Somewhere along the way, like people started to dislike Facebook and then that started to turn again. But like Mark is probably one of the top 5 CEOs in the industry today.
So then my follow up is like, why do you think he's a top five CEO, and who are the other people that you would consider to be up there with Mark Zuckerberg?
It's I'm going mainly on like he's able to chase down opportunity. He's able to push the company to move very quickly, and he's very deliberate about his decision making. So, like, if you look at how Facebook is architected, it very much, and I think actually a lot of the VPs and maybe the directors don't even understand this, but it very much is a system that is oriented around trade offs. And even the way the organizational structure is done is very deliberate in terms of like, we are sacrificing X to get Y because Y is more important. One great example of this, and like some people at Facebook might disagree with me, but the traditional PSC system or performance review system, like everybody that's a manager hates it because it just takes hours and hours and hours of time. Um, and people do all-nighters to get like their performance packets for the reports done. And in like comparison, other companies it's like very lightweight to do performance reviews. But the philosophy behind that is the stars of the show at Facebook are the ICs. So we don't actually care about manager work-life balance. We care about fairness for ICs and getting them the best and most accurate rating and the best rewards possible for their work. So that's like the very explicit trade-off that the company is making, and the design of that system is meant to do. And that's how Zuck thinks, and that's how he's architected the company, which makes him fantastic. It's hard for me to actually say like what other CEOs are that great because I haven't worked with a lot of the other ones, right? But I'll say like another person that has very explicit structured thinking like that, at least in his public statements, was Jeff Bezos. Very structured and very explicit about the trade-offs that he's actually making in the architecture of the system.
Yeah, I think that was some good insight into the mind of how these guys think. And like, these people are obviously phenomenal CEOs. They've done super well for creating shareholder value and just for helping, like, yeah. So my next question is, so what is your hot takes on the VC ecosystem? And what could you share on that front?
Um, Hot takes. Oh, let's see. Well, I don't know if this is a hot take, but I think in this current cycle, a lot of venture investors are going to lose a lot of money, and you're not going to see great returns for a vast majority of funds, potentially even some of the well-known funds. And the reason being, I think, is that entry valuations are just too high. Um, People have a little bit of FOMO from missing out on OpenAI, and people are a little bit caught up in the transformation that AI can actually do. And and some of these companies have like really great, potentially large exit outcomes that could happen. But they're forgetting that no matter how good a team is and how good a market is, there's risk in venture. And the math just doesn't math if you give seed stage companies like a few $100 million valuations, right? And we're seeing this over and over again. Um, and I think this is extraordinarily risky because like some of these are great technical teams, but these potentially are not great or direct markets where they can dominate. For example, like I think in video models, you have some fantastic teams here, but they're all going to struggle against someone like OpenAI or Google or Facebook because the answer in video models is not like who has the better algorithm. It's literally who has more GPUs. Because like your algorithm can be 2 times better or even 10 times better, and I can just outpay you in GPUs and still have a better model. And turns out like Facebook and Google have 100 times lower cost of capital than any startup, so they can just outpay anyone, right? And for video models, that's something TikTok and Facebook definitely care about, and YouTube definitely cares about. So like, I do think some of these valuations are a little bit concerning. And I also will say this is probably this is less of a hot take and more of just a curiosity, but people like to make the argument that hardware startups are expensive and therefore they end up raising a lot of money to build hardware, but their valuations are not much different than other companies. But the difference is like they end up giving up more equity. So you might give away 50% of a company for a hardware startup in the seed rounds. That argument hasn't been made for robotics, or it used to be made for robotics. It's changed a little bit because robotics has become AI, and for AI companies. And what's really just happened there is like you spend $30 million on GPUs, and they just raise the valuation at the seed stage instead. Versus like I think that's interesting because you could argue that a foundation model company is just a hardware startup, and the hardware you're buying is GPUs. So I wonder how this shakes up for this vintage of venture funds. And there's a lot of very inexperienced VCs out there. So when you see some of these crazy valuations, I look at things and I can usually if I can logic myself into why that valuation makes sense, you look at it and there's an experienced partner that's actually leading. And then when I can't and you look at it, it might be a very new partner that or like someone new to venture or not that experienced in venture that kind of did that deal. So I wonder where things can actually go.
Yeah, I think those are some really good hot takes. And yeah, thank you so much for coming on the podcast today. Super honored that you came on because you don't do a lot of podcasts. So it was an absolute honor to host you on the podcast. And so yeah, do share like how the audience can get in touch with you, how they can pitch, and like anything you want to share, like now's your stage.
Yeah, so we end up doing, or I actually focus anywhere from pre-seed, seed, and A, and I will look at B. B's are on that line of like early stage towards growth. So that's like the stage that I generally play in, and I'm open to like people reaching out to me on LinkedIn and throwing me pitches, or just like figure out a way to find my email and just throwing me pitches in the email inbox. I don't always respond, or like on Twitter DMs. I don't always respond, but I usually at least read through the slide decks. And if something piques my interest, I'll go reach out. It is I will say like there have been investments that have come through cold outreach, but it is fairly rare in the sense that it's a high volume game, right? There's like many pitches that come in, and very few actually go and pique the interest.
For sure, for sure. So thank you so much for sharing your insights, and it was great to talk to you about